that are outpacing their peers. They're growing faster than their peers are, and they're in that particular sector. That's our foundation. Now our walls are going to be our parameters. Let me write that in here real quick. And the parameters are what kind of sectors do we want to put in there? Do we want to use financial sectors? Do we want to use healthcare sector? Do we want to use energy? We can pick all these different sectors and fill this house that I'm building with those kinds of stocks. Let's say we put 300 companies in here. They all have to be large cap growth. So we're going to be looking at different areas, different sectors in our entire economy. So it's a good idea when they do this because you're spread out, you're diversified over many different types of sectors. And then for our roof, we've got to decide how much cash. Remember I talked about that earlier in the show. How much cash are we going to keep in this fund? Because too much cash can cost you too much in lost opportunity. Now, the fund creates this, and they create, real quickly here, 3 of these funds. So they have Fund 1, Fund 2, Fund 3. They all have the same objective, parameters, and cash, and they assign a manager here, manager here, manager here. Now they're going to track for at least 1 year which of these funds do better. Now you'll never know this because this is not available to the public yet. This is the fund company using their own funds and money to fund these things. Now let's say this first one makes 9% in a year. The second one makes 3%. The third one loses 12%. Well, what the fund company is going to do is it's going to take this and look and say, okay, obviously this is the winner. So we are going to tear down these 2 funds and consolidate them into this fund, and then we're going to offer it to the public and say this fund made 9% last year, or 10% or 12%, whatever the highest fund made. And they are going to make these numbers, folks, disappear. They're going to vanish. They never existed. And you don't know that. So when they give you the number of what they did in the previous 12 months for a new fund, you can rest assured it's the best one out of a group of 3. They might do 4 or 5, but you'll never know what that fund truly did. When you average these numbers up, you get a much different picture, don't you, than 9%. But that's how a mutual fund, in its most simplistic form, is built. They don't just put something together and offer it to the public. They use this incubator phase and they populate it, and they have several people working in it. They find out who's doing the best, who's making the best decisions, and that's the one that wins the job, wins the manager fund, and wins the prize at the end of the road. And folks, you think you're getting a fund that's done 9%, when in reality it may have done poorly in the previous 12 months. And one other thing that they failed to put in here, this has no expenses taken out of it whatsoever. If this is let's be modest. Let's say this is a fund that costs 4%, which is outrageous in price. I'm just saying modest compared to our other figures that we used earlier, about 8 and 9%. That means this fund only did 5. But they won't report that. This fund did a negative 1%. This fund was down negative 16%. They'll show you 9%, and they'll do that from now on. You see a fund that says, we did 36% last year, you'll think, my goodness. But you ask someone, anyone who's been in that fund for 12 months, if they made 36%, and every time they'll tell you absolutely not. I've had clients come in and say, Steve, I was in this fund for this long. I looked at the prospectus, said the fund made this amount of money. I made less than half of that. What happened? I said it goes back to those fees. Those fees can kill a portfolio, folks. You've got to build a portfolio that is conscious and aware of the expenses within. And I'm not saying all mutual funds are bad. There are some mutual funds that are very good. There are mutual funds that are less than 1% in total fees. Those are the funds you need to find. But you're not going to find it in the prospectus. You're not going to find it in the literature from the mutual fund, and you're not going to find it in the newspaper. You're going to have to go to someone who can look at that and analyze it and research it and tell you what that number is. And again, I can't stress enough, if you want to know how much you're paying in your mutual funds, go to our website, youmeandwallstreet.com, and click on our email address and send us your ticker symbols, even the ones in your 401k. Because what you'll see reported is the expense in this fund is 0.8%. You'll see that over and over and over. Folks, that is the management fee. Let me do a little quiz here, folks. How many expenses did I say were in a fund? 6. It's hard to hold up with a pen. 6 expenses. They'll show you 1, and probably the cheapest one at that. So my friend, if you want to be a smart investor, if you want to make the money that you need to make for your retirement, if you would like to increase your income without increasing your risk one bit, cut your fees. I'll close with this. John Bogle said, to be in the top quartile of returns, you need to be in the bottom quartile of expenses. And let me give you one more quote that we use on this show. The quality of life is not summed up just by the quantity of your possession. We'll see you next week on You, Me, and Wall Street. Good night. And the don't count so fast. I was sweating. You count so fast. And finish with the continue on and finish. Wahoo!